So our lesson last week was mainly about inventory. And we saw that inventory are the assets that we are selling. And when we buy something, we record the cost. So if you buy the inventory for $10, you record inventory $10. But how about when you make something? When you make something, you buy the raw materials, and then you pay the workers to use those materials to make something. So when we are in a factory and we make inventory, should we add the cost of the workers to inventory? Yes. So when you buy inventory, it's a little bit easy. Your inventory is the purchase price. When you make inventory, the cost of the inventory is purchase price of materials plus the cost of making the inventory. For inventory, we say that the cost of inventory is all the cost to get the inventory ready to sell. If you buy inventory from Korea and ship to Cambodia, we would add the purchase price plus the cost of shipping to us. Plus, when the inventory arrives in Cambodia, there might be some customs duties, some taxes. We would add those taxes to the cost of inventory. Except we don't add taxes that we would get reimbursed for, like VAT. So inventory, the cost of inventory that we record is all the cost to get the inventory and to get it ready to sell. Today we're looking at property, plant, and equipment. So property, plant, and equipment are assets that we're not selling. They're assets that we're going to keep and use. So your property, plant, and equipment is your building, your furniture, your machines, your generator, your computer system and computers. So this is your property, plant, and equipment. They are the assets that you are using. But the principle of accounting is the same as inventory. For PPE, we also record all the cost that it takes to get the PPE ready. We say ready to use. So for PPE, we record all the cost to get the PPE ready to use. For inventory, we say all the cost to get the inventory ready to sell. So if you're making shoes, you pay the workers' cost of making the shoes, you add to the shoe inventory. What if you are constructing a PPE building? You're constructing a building that you want to use. Well, the cost of the workers building the building, you will add to PPE. You record as PPE. You don't record as expense. So just like inventory, the cost of your workers to make PPE, you add to PPE. If you buy PPE from another country, like a generator from Germany, and you import the generator from Germany, you will take the cost of shipping, the taxes on arrival, you will add to the cost of PPE. So the cost of PPE is more or less the same as the cost of inventory. And we left off last week looking at this. I'll come back to the previous slides. We can start with this example. So this is an example where you're making PPE. Maybe you're making a building, maybe you're making a machine, you're getting some machine ready to use. So it says here the price is $750. So of course we will add the price. How about shipping and handling? The shipping of the machine to bring it to Cambodia. Should we record as expense or should we add to the asset? We'll add to the asset. So the cost of shipping the PPE in, we add to PPE. How about installation? Should we record installation as expense or record as asset? Also asset. So all the costs to get the PPE ready for us to use, we add. And we need to install, so we add. Concrete reinforcement. Concrete means beton. I think it's like a kind of cement. Concrete reinforcement, should we add?
No.
So the beton. Do you need it?
Yes.
Can you put the machine without this?
No.
No, we need this to put the machine in place. So it seemed like we need this to install and use the machine, so we will add. Electrical cable, gap, to connect to the machine.
Yes.
Yes, we need that too. We can't use the machine without electrical cable, so we add that. We add to asset. So all these costs we add to the asset. No, there's no expense here. How about your own labor cost to prepare and install? That means the cost of your staff.
Yes.
We also add. So, and before we had an installation up here, and then we have some installation down here. So maybe the first installation you pay outsiders to do some work for you. And the second one below, it says own labor. It means you have your own staff to do the work. So it doesn't matter if you pay the outsider or you pay your own staff. Both costs are added to PPE. So when you pay your own workers, the cost of your own workers also is added to PPE. And then engineering pre-production, testing. Now testing is an interesting one because it seemed like the machine is all ready. So should we add the testing? So do you need to test before you use it? Probably in this case the answer is yes. You need to do some tests to make sure that the machine is running properly, running correctly. So we assume that yes, you need to test it before you use it. So we add the testing also. Now, an important principle is that we stop adding cost when the asset is ready to use. We stop adding cost once it's ready to use. And then maintenance. When does maintenance happen? It happens after, right? It happens after the machine is all ready for us to use. So, because the machine happens after the machine is ready to use, we don't add to the cost. So maintenance is always recorded as an expense. It's always an expense. So this is an expense. So maintenance is always expense because it happens after the machine is all ready for us to use. The company noted the following. The company received a trade discount of 8% on the list price. And discounts always make the cost go down. For PPE, also for inventory. Whenever you get a discount on your inventory or a discount on your PPE, we minus from PPE, we minus from inventory. Discounts make the cost of your inventory go down. Discounts are not income. We do not record as income. We reduce the cost of the inventory. We reduce the cost of the asset. So if we go back above here, we need to minus the discount. And then we would get the net amount. I think there's an answer on the next page. Yes. So discounts we minus from cost. Discounts make the cost go down. B, of the 1,400 spent on electrical cable, this is referring to that. 1,000 was due to installing the wrong type of cable, which had to be removed and thrown away. This is a mistake. If you make a mistake, you don't add to the cost. So mistakes are not added to the cost. Mistakes are recorded as an expense. So in this case, the 1,000, we will not add the 1,000. We would just add 3,500. And the 1,000 mistake, we would record as an expense immediately. And then C, the machine is installed in a rented factory building. The building owner requires that the machine be removed at the end of the lease in 7 years. The removal is estimated to cost $2,000. Now, in IFRS and IFRS for estimates, we have the rule that we need to add any cost of removal. Most of the time, and we only add, so IAS 16 says we have to add the cost of compulsory removal or restoration. The key word here is compulsory. Compulsory means you must do it, it's required. Now, if you install a machine in your own building, are you required to remove it? No, it's your building. If you want to remove, it's up to you. You are not required by anybody. Compulsory required removal can only be if you have a contract with someone else to remove. So maybe you're renting the building, you have a contract with the owner of the building that you must remove or restore. So then it's required, it's compulsory. So we add the compulsory cost of removal and restoration. So removal and restoration, we don't add unless it is compulsory, it's required. And also, we usually don't add anyway. Because the cost of removal, usually it's so small that we can just ignore. So usually the cost of removing a machine, it might be, it might cost so little. Sometimes we can remove for $10. You can hire the HI. They can come and remove it for you or something like that. Or at the most, if you need some workers to remove something, it might cost a few $100s. So removal, usually we ignore, but in the standard, we add it. And in practice, we would add it if there was some kind of large restoration or removal, we would add. But usually we don't have that, so we can ignore it. But on your exam, add. So on your exam, if you see in the question the cost of removal, cost of restoration on the exam, you add it, add to PPE. So this 2,000, we're going to add this 2,000 to the cost of PPE. That's interesting because the cost of removal is going to happen far in the future. It might happen in 5 years, 10 years. But even though it's going to happen in 5 or 10 years away, we add now. So in this example, this would be the cost of the plant. So we have the price minus the discount plus shipping cost, installation, beton, the XICAP, the functional chemical, the testing, and we add the restoration all together. So, and this gives us PPE. Now, this is kind of a complicated question. Most of the time, PPE is going to be easier. If you go to the market, you buy a computer, the cost is just the price you pay. But in this case, the PPE, we are constructing and installing PPE. So we have some additional costs. Let's go back to the slides that I skipped. This very first slide we looked at last week, and it can be good for us to review the definition. Property, plants, and equipment are tangible. Tangible. How do you say tangible in Khmer? Like this? Is that right? Yo. Like that? Anyway, I don't know if I wrote that correctly, but tangible means physical, you can touch. So what would not be PPE is computer software. What would not be PPE would be a brand. What would not be PPE would be a license. So that's not PPE. So how about receivables? Is receivables PPE? No. Can you touch receivables? No. Okay, so PPE are assets that you can touch, so physical assets. And in the standard, tangible, it says tangible. Touch. Held by an enterprise for more than one accounting period for, keyword here is for use. So PPE are the assets that you are using. So it does not include inventory, right? Because are you using inventory? No, inventory you're going to sell. You sell inventory. So PPE is different than inventory because PPE you keep, you will use. And then for rental to others, so that's interesting. If you're a car seller, and you have cars that you're selling, the cars you're selling are your inventory. But if you keep some cars to rent to other people, those cars are your PPE. So PPE includes the assets that you rent to other people. If you rent a car, a generator to other people. Maybe you sell some generators, those are your inventory. And some generators you are renting to people, those are your PPE. But there's this exception here, except land and building. So when we rent land and building to someone, the land and building is not PPE. Land and building that we rent to other people is, as it says here, is called investment property. Investment property. And we can remind ourselves what the word property means. Property means land and building. Now, in normal English, my calculator is my property. But in accounting, property means land and building. So investment property means investment land and building. So investment property cannot include a machine or a car or a boat. Investment property is only land and building. Okay, so I have a house I rent to someone. I have a house, I'm renting the house to someone. Is that PPE? I am that house is investment property. And then I have one house I use as my office. That house is PPE. So land and building you keep and use is PPE. Land and building that you rent to other people is investment property.
No. This means when land and building rent to be based on.
You have two choices. You can record as fair value and you don't depreciate, or you record at cost less depreciation, the same as PPE. So you can account for investment property the same as PPE if you want to. And then you have depreciation. Now, there are two standards we can follow in Cambodia. In Cambodia, we can follow CIFRS or CIFRS for SMEs. In CIFRS for SMEs, there is no depreciation of investment property. So if you follow CIFRS for SMEs, there's no depreciation of investment property. But if you follow CIFRS, then you have a choice. You can depreciate or not depreciate. It's your choice. How about if we have a business that has ships that we are using to carry goods up and down Tonle Mekong. We have some ships. And some ships we are using ourselves, and some ships we rent to other people. The ships that we use ourselves, is it PPE? Yes. The ships that we rent to other people, is it PPE? Yes. Yes. So, ships, the investment property is only land and building. So if you have ships that you rent to other people, if you have cars and trucks you rent to other people, if you have generators you rent to other people, that is PPE. That's PPE. It is only land and building that we make the investment property category. And for accounting, we will put PPE into a class. Class just means a group. And it's a group of similar PPE. Your class, you can choose up to you. Your class is up to you. You can group your PPE as you like. And here are some examples of classes. You can make your own classes of PPE. In your accounting system, you may have many classes. In your chart of accounts, you might have 10 classes. You might have 15 classes in your chart of accounts. But in your financial report, you don't need to show all of the classes. You might show only 2 classes or 3 classes that you combine, where you combine the other small classes together. How many classes should you show in your financial report? You should. It's up to you. You should show as many classes in your financial report as you think is useful for people. So that might be between 2 and maybe a maximum of 8. You should not show 10, 15 classes of PPE in your financial report. You should combine, in your financial report, you should combine. I think 4 classes is, for most companies, disclosing 4 classes is enough. For many businesses, even 3 classes would be fine. For some, 2 classes. So, in your accounting, in your chart of accounts, you might have many classes, but in your financial report, you should have less classes. You shouldn't show all the classes. Just show what you think is important to investors, lenders. And this slide summarizes what we add to cost. And the key point is cost includes all the costs to get the asset ready for use. And when the asset is ready for use, then we stop. We stop adding cost. So we look for the day is ready, we stop adding cost to PPE. And you can use your own idea, you can use your own logic if the cost is needed to get the asset ready for use. But the standard also gives us some ideas. These are some ideas to add. So you should add the purchase price. You should add the cost to bring the asset to the location. That means shipping in. You should add any import duties. That means any tax. Except we don't add VAT. We don't add taxes you can claim back. So we don't add VAT. But if you are an NGO, can you claim the VAT back? No. So for a business that can't claim the VAT back, the VAT is added to the cost. So for the NGO will add VAT to the cost, assuming the NGO cannot claim the VAT back. But for the company that pays VAT, you can claim the VAT back. So for the company that pays VAT, you do not add the VAT to the cost of the asset. And then installation, we add installation, and we add the cost of required removal. And here's the hard one. We add the borrowing costs. Borrowing costs means kapra, interest, but only interest during construction. So the borrowing number six here, borrowing costs. That's only if you're constructing yourself. So if you are constructing the building, you add the borrowing costs during construction. When the construction is finished, then we do not add any more interest. But during construction, we add interest to the cost of the building. If you buy a building, you don't add any borrowing costs. You only add borrowing costs if you construct yourself. Or you pay someone to do the construction, and you have borrowing costs, you have interest. And number 7, you add any major renovation. So accounting standards makes a difference between maintenance, repair, and renovation. Repair, we are just keeping the asset in normal working condition. But renovation is meant to be more than a repair. Renovation means you're increasing the value above the normal working value of the asset. So major renovation, you add to PPE. But repair is an expense. But renovation is an asset. And PPE, as you already know, most of you already know, we're going to depreciate. How do we say depreciation in Khmer? Like this? Is that right? No? Teach you academy, teach me Khmer. Okay, so depreciation. In English, we have depreciation, and then we have another word in English we call amortization. In British English and S, in American English, we say with a Z, right? Amortization. What about what? Depletion. Yes, I'm not sure if the Khmer word for depletion is the same as rumlo, but amortization and depreciation are. So depreciation in Khmer rumlo, amortization in Khmer is rumlo. And depreciation is for physical assets. Physical assets. And amortization is for intangible assets. So in Khmer though, it's just both is rumlo. For depletion, I don't know the Khmer word. How can I say depletion? But I do know that in Khmer, amortization and rumlo, depreciation and rumlo. So in English we have the two words, but in Khmer just one word. So amortization is for intangible assets and depreciation is for the physical assets. So PPE is physical, so PPE we say depreciation. So how should we depreciate or record measure after we record the cost? There are two models. And the cost model is used by 99.9% of businesses. The revaluation model is not used that much. So it's less popular, and it's used mainly for land and building. So if the company does use it, they use it for land and building. So we don't revalue a car, we don't revalue a machine, we don't revalue furniture, we would only revalue land and building. The cost model is good for assets that only go down in value. So when you buy a car in the beginning of the year, is the car in the end of the year going to be more or less? Less. Sometimes less or always less?
Always less.
Always less. So the car always goes down in value. The machine always goes down in value. The furniture always goes down in value. So the cost model is appropriate. But how about land? Does land always go down in value or up in value? Can't go up and down. Of course, in Cambodia, mostly in the last 20 years, going up. And probably keep going up for quite a while, maybe another 20 years. But doesn't mean that it's always like that. In Japan, land prices went up for 25 years, and then they went down for 20 years. So we are lucky that right now we're in the up period. So cost is not that good for land and building, because cost means you keep the original cost for land. So if you buy the land 10 years ago, is that the true value now? The price you pay for land 10 years ago? It's going to be very different than the value now, right? It's going to be much lower than the real value. And do you think the owners of the business, do they want to know the real value or they want to know the value from 10 years ago? They want to know the value now. So if you want to know the value now, revaluation is going to be better. So revaluation will give you more true information, up-to-date information. Revaluation gives you more useful information for your land and building. And cost, for land and building, cost gives you almost useless information. Because who cares? Who cares what the value of the land was 10 years ago, 20 years ago? It's meaningless information. But even though cost is meaningless for land and building, most companies still use cost for land and building. So most companies only use cost. They use cost for everything. They use it for land, they use it for building, they use it for meats, they use it for everything. Probably your business, you use cost for everything. But revaluation can be good. It can be good for land and building to show us the true value of our land and building, to give more meaningful information, to give more useful information. And in accounting, that's what we want. We want to give useful information. And revaluation is on our exam, so we need to know revaluation for our exam. The cost model is just cost less depreciation. For revaluation, we will revalue at the end of the year. But for revaluation, we still have depreciation. So both ways there's depreciation. So for the cost model, we have depreciation, and for the revaluation model, we also have depreciation. So for cost, we have depreciation, for revaluation, depreciation. So either way, depreciation. Now, can we revalue some land and not some land if we revalue? No. If you revalue, you need to revalue all the assets in the class. So if you have a class of land, it means you have to revalue all the land. And we will study revaluation in the second half of this lesson. So on our exam, we have two kinds of depreciation. The first kind of depreciation is called straight line. And the second depreciation we have on our exam is called reducing balance. These are the two depreciation that are popular in Cambodia and around the world. So around the world we use reducing balance and straight line. There are other methods. There's a units of production method. There's different kinds of reducing balance methods, some called sum of the year's digits. So there are different methods of depreciation, but most companies are going to use straight line or reducing balance. And our tax law in Cambodia also uses straight line and reducing balance. So this is a formula for straight line depreciation. The depreciation every year is equal to the cost minus the residual value. What is the residual value? The residual value is the value of the asset at the end of the useful life. It means when you are finished using the asset, what is the value after you are finished using the asset? And then disposal cost means the selling cost. How much does it cost to sell the asset when you're finished? And then years of useful life. So let's start with useful life. We have a teacher at CAMED. His name is Douglas Froggatt. And he's from the UK. He usually teaches in our CAT program. Has anyone studied with Douglas? One. Okay, two. Okay, Douglas has a Vespa. He drives a Vespa motorcycle. And his Vespa motorcycle is from 1959. So, 60 years old. His motorcycle is 60 years old. So, should we depreciate the motorcycle 60 years? Why not? Is it possible to use a motorcycle 60 years? Yes, it's possible, but it's not normal, right? Useful life is not how many, it's not how many years you possibly can use the asset. The useful life is how many years that you believe your company will use that asset. So it depends on your company. It depends on your experience in your company. It depends on the plans of your company. So for your company, how many years do you normally use a motorcycle? How many years do you think you will use the motorcycle? So it depends on you, depends on your company, depends on your company's experience, depends on your judgment, depends on your plans. So maybe the useful life of the motorcycle might be 6 years or 8 years, something like that. Can you use a motorcycle more than 6 years?
Yep.
Yes, but the useful life is not how many years you can use the motorcycle. The useful life is how many years your company will use the motorcycle. So if your company will use the motorcycle for probably 8 years, the useful life is 8 years. Now, let's say we have 2 taxi companies. One taxi company is for Net Mian, the VIP taxi company. They always like to have the new car, the fancy car. The other taxi company is a cheap taxi company. They try to give a cheap price. They try to use the car as long as possible. So for the cheap taxi company, the useful life of the car might be 10 years, 15 years. But for the VIP taxi company, maybe the useful life is 5 years. Because they try to keep the new model, the new car. So the useful life can be different from company to company. So your company has a useful life of 5 years, but my company might have a useful life of 15 years. Because we have different plans, different activities. So the useful life is how many years that your business expects to use it, how many years you expect to have that asset. The residual value is the value at the end of your useful life. So if your useful life is 15 years, the residual value is the value after 15 years. If your useful life is 5 years, residual value is the value after 5 years. So the residual value depends on your useful life. Now, many companies think that the residual value is small, and they will often put a residual value of 0. And many companies think, well, the disposal cost is small, so they put a disposal cost of 0. So many companies will just take cost divided by the years of useful life. And that's okay as long as the residual value is small. Also, not only will the residual value be small, but the residual value is far, far away in the future. So the residual value is really an unreliable number. It's an estimate. So it's small, it's a far away in the future, and it's an unreliable number. So many companies just put 0. So you have to consider to yourself, is your residual value significant? If it's significant, then you should estimate. But if it's some small amount, then you can just put 0. Like a chair. Should we have a residual value for the chair? No, it would be too small. Maybe we can sell to HI. Maybe after 10 years we sell to HI for keep one real or even $1. So it's too small. We just ignore it. But on your exam, no, you don't ignore it all. On your exam, we'll take cost minus residual value plus disposal cost. And divided by the year's useful life. So let's look at an example. It says a non-current asset costing $60,000 has an estimated life of 5 years and a residual value of $7,000. The annual depreciation charge using the straight line method would be cost minus the residual value divided by the useful life. Okay. And so that gives us the depreciation every year. Now, what is missing from this example? There's no disposal cost, right? When we looked in the formula, it says here disposal cost. Sometimes your exam doesn't give you disposal cost. They don't give you the disposal cost. If they don't give you disposal cost, leave it out. Also, sometimes they might not give you the residual value. If they don't give you residual value, just leave it out. So we just use the numbers that are given to us in the question. And the journal entry is debit, depreciation expense, credit, accumulated depreciation. And we debit accumulated depreciation, credit accumulated depreciation. Accumulated depreciation makes the asset go down. But notice we don't do this. We do not debit depreciation and credit PPE. No, we don't credit PPE. We credit the accumulated depreciation account. We don't credit the PPE account. But accumulated depreciation makes PPE go down. So we can see the example here. So we have the cost of the PPE, $60,000, accumulated depreciation, $10,600. So 60,000 minus 10,600 is equal to 49,400. This is called the carrying amount. So the carrying amount is cost less accumulated depreciation. And the carrying amount, this is the number we show. This is the number we show in the statement of financial position. The Durang Tolerka. So accumulated depreciation makes PPE go down. We say that it is a contra account. So accumulated depreciation is a contra account because it makes the balance of another account go down. So accumulated depreciation is a contra account. It makes the balance of another account go down. For intangible assets, we have accumulated amortization. Accumulated amortization is a contra account. For receivables, we have the allowance for bad debt. Allowance for bad debt is a contra account. And for sales revenue, we have sales returns. sales returns is a contra account, it makes sales go down. And for cost of inventory or purchases, we have discounts received. Discounts received makes the cost of inventory go down. So a contra account is an account that makes another account go down. So accumulated depreciation reduces the balance of PPE, reduces the cost of PPE that we show in the balance sheet. So this is straight line, and so straight line depreciation, something that we should know is that it's the same every year. So with straight line depreciation, the first year depreciation, 10,600. Depreciation next year is 10,600. Depreciation the next year. Every year is the same. This is straight line depreciation. Every year is the same. And that's different than reducing balance depreciation. In reducing balance depreciation, the depreciation every year is different. And reducing balance depreciation, the depreciation will go down, down, down. It gets smaller and smaller every year. So let's look at an example. Well, the formula is the depreciation is equal to the cost, or opening carrying amount, times the percent. The reducing balance percent. The reducing balance percent, it's up to you. It's your estimate. Your estimate of how much the value goes down every year. It's your estimate of how much the value of the asset goes down. So you have to use your own judgment. And in the tax law, they give you the reducing balance percent. So how about for computers and electronics in the tax law? What is the percent? It's 50%. 50%. So the tax law tells us some percents for paying tax. But remember, the tax depreciation is not the same as the accounting depreciation. The accounting depreciation is based on your useful life, based on what you truly believe the value will go down every year. So the percent is up to you. When we do the reducing balance percent, we don't minus any residual value. So you can see there's no residual value in the formula. Is there residual value for the asset? Maybe there's residual value, but we don't put it in the formula. So we're ignoring the residual value. So let's say that we have an asset that costs 10,000. So asset cost 10,000. Let's say the percent is 40%. So 10,000 times 40% equals 4,000. And then after a year, so at the end of the year, it's 6,000. And the next year is 6,000. 6,000 times 40% equals 2,400. So depreciation year 1 is 4,000. Depreciation year 2 is 2,400. Depreciation in year 3 is 1,440. So the depreciation gets smaller and smaller every year, the depreciation expense. And you can see what we do here is when we times depreciation, when we times the reducing balance, it's going to be cost. If we adjust the formula here, it's going to be cost minus accumulated depreciation, and then times the reducing balance percent. So we always minus the accumulated depreciation before we times the reducing balance percent. I have a very simple exercise for you to do here. Let's have you try this first question. Can you tell us what is the depreciation? It says here for the first year, but let's do the first 2 years. Under the straight line method and the reducing bounds method. It might seem easy for you, but do it, because this is on your exam. Your exam will ask you about straight line and reducing bounds. So let's make sure that we know it. It says here a lorry. Lorry is a UK word for a truck, especially a kind of a delivery type truck. Okay, so what is the depreciation in year one for a straight line? So cost 17,000 minus the, it said scrap, right? So that is the residual value. Scrap is the residual value. So we minus residual value. Is there any cost of disposal? No cost of disposal. So if we don't have cost of disposal, we leave it out and then divide by a useful life of 5 years. So 17 minus 12, 15 divided by 5 is. And next year it's going to be? Same. So the straight line depreciation is the same every year. And using the reducing balance, we take 17,000 times 35%. 5950, that's right. And then the next year, we take 17,000 minus the first year. Which gives us 386, I'll round up to 8. So the depreciation gets smaller and smaller every year. And we do not minus the residual value. We are ignoring the residual value. You might say that it's wrong to ignore the residual value, and you would be right. But we might say, well, the residual value is considered when we think about the percent. So we might have considered, when we estimate 35%, we might have considered the residual value in considering and in finding the 35%. So the 35% might have considered residual value. So, any questions? How about a building? What is the useful life of a building? It's long, right? So if a motorcycle is 7 years, but for the building, of course, we should consider how long we're going to use the building, and but in accounting, we assume that we always have this assumption. There's the underlying assumption that we are a going concern. So going concern means we assume that our business will always be going. even though we might not be going in 20 years or in 50 years, but we have this assumption in accounting that we are a going business, a going concern. That means going forever. So building could have a useful life of 50 years, 80 years. It's possible. So buildings can be more than 20 years. I think a 20-year building is not a very good building, right? Would you be happy if you bought the building and the building only lasts for 20 years? Yeah, I don't think you would be happy. So I think the useful life of the building must be more than 20 years. So 50 years, 60 years, 80 years. How about computers? What is the useful life of a computer?
3 to 5 years.
3 to 5 years? Well, I haven't done proper research into the useful life of computers, but I know my laptop. I tend to change my laptop every 4 or 5 years. I think the last one lasted 5 years. Can you change the expected life? Yeah, change in expected life. You can also have change in residual value. You can have also change in the method, change in depreciation method. Maybe you change from reducing balance and you change to straight line. So it's okay to change. You should change on what you think is the truth. So if you're using your factory building and you see your factory building is falling apart, maybe before the useful life is 50 years, maybe you think now the useful life is just 20 years or 15 years. So you revise. Sometimes you need to revise the useful life. In IFRS, we have to review the useful life every year. You should review the useful life of each class of assets every year. But in IFRS for SMEs, you don't need to review the useful life every year. You only review the useful life in IFRS for SMEs. You only review the useful life in case you have some evidence that the useful life changed. Anyway, our exam's on IFRS, and IFRS says that we have to review the useful life every year. And you can change. You might change the useful life. That's okay. But when you change the useful life, then we have a problem. Or if you change your method or residual value, we have a problem. Because normally, we take cost divided by useful life. But if you change the useful life, if you change the depreciation method, or if you change the residual value, then you're not going to take cost divided by useful life. You're going to change to the carrying amount on the day that you changed, on the revised date, on the day you change your method, divided by useful life. So we switch from using cost to using the carrying amount. So it's okay to change the useful life. It's okay to change residual value. It's okay to change your depreciation method. But if you do, you're going to switch from cost divided by useful life. You change to the carrying amount divided by useful life.
What happens to the depreciation expected or repeat?
You still keep it in accumulated depreciation. So we will keep it and leave it. We won't change it or anything like that. We just keep it. So let's look at an example. Cliff purchased an asset for $100,000 on 1/1x1. It had an estimated life of 5 years. It was depreciated using the straight line method. On 1/1x3, Baxter revised the remaining useful life to 8 years. Okay, so the years we have x year. We have x1, X2, X3. And depreciation expense. And so X1, the depreciation expense is going to be 100,000 divided by 5 years. So depreciation is 20,000. And accumulated depreciation is 20,000. And then in the second year, it's the same. Accumulated, how much is accumulated depreciation now? Now it's 40. Okay, now in X3, in the third year, we change the useful life. So if we change the useful life, the depreciation, we're not going to use cost divided by useful life. We're going to use the carrying amount. The carrying amount is 100,000 minus 40. So this is the carrying amount. So 60,000. And then we're going to divide by, now it says useful life is 8 years. So let's assume that 8 years means 8 years in total. Oh, no, I'm sorry, it says remaining. Time perbaikan, remaining. So in total, 8 years plus, we already used 2 years, so total useful life is 10 years. Anyway, remaining, no saw. So remaining means no saw, cumnun saw. So saw perbaikan, okay, divide by 8 years. So 60,000 divided by 8 years is 7,500. And accumulated depreciation is now going to be 47. Is tax depreciation the same as accounting depreciation? It's not. So that's why in the tax form, when you pay your annual tax and profit, what you do when you pay the annual tax and profit is that you add back accounting depreciation and then you minus tax depreciation. So when you do your tax return, add back accounting depreciation and then minus tax depreciation. Okay, another example of changing the method. So this is very similar. It looks like it's similar. We purchased the asset for 100,000 on 11X1. It had an estimated use of 5 years. It was depreciated using the reducing balance method at a rate of 40%. On 11X1, it was decided to change to the method to straight line. So year, we have X1, X2, X3. So our depreciation expense is 100,000 times the reducing balance of 40%, 40,000. Accumulated depreciation 40,000. And in the second year, 100,000 minus 40,000, 40%. So 60,000 times 40%, 24,000. Accumulated depreciation now is 60,000. So in the next year, we're going to switch to straight line. The useful life is 5 years. We already used 2 years. That means we have left 3 years. So we're going to divide by 3 years. And the carrying amount is now 100 minus 64. And then divide by 3 years. So this is a carrying amount. And in this example, now we switch to straight line. What is the expense in X4? It will be the same. And then in X5, the same, because now it's become a straight line. What is easier, straight line or reducing balance? Straight line is pretty easy, right? Can you use straight line for everything? Yes, you can. For your business, you can use straight line for everything. Fine, no problem. Okay, the next question is really the same topic, so I'll leave the next question for after the break. So I'll give you 10 minutes to forget everything, and then we'll come back. We'll look at the next question. It'll help us to review and refresh. Okay, so let's take a short break, and after that we'll come back and we'll review this idea. question. It says, Kaylee Company purchased a machine with an estimated useful life of 5 years for $34,000. On 30 September 2005, Kaylee Company planned to scrap the machine at the end of its useful life and estimated that the scrap value at the purchase date was $4,000. So scrap value is a kind of residual value. When I think of scrap, I think that it means when you finish using it, you're not going to use it anymore. It's just going to be thrown away. So you just take the metal materials. On 1 October 20X8, Kylie revised the scrap value to $2,000 due to the decreased value of scrap metal. So the revision of the residual value, we're going to do the same thing that we did with the revision of the useful life and the revision of the method. So we'll just take the carrying amount in the year that we revise. We'll take the carrying amount divided by the remaining useful life. And so they're asking us 20x9, and we purchase it on 20x5. Now this is sometimes your exam will give you the strange date. So 30 September, if 30 September is the beginning of the year, well, this is the end of the year. What is the beginning of the year? The October 1st. So if 30 September is, or October 1st, 20x5 is the beginning of the year, the end of the year would be 20x6. So September 20x5 this year, the end of the year is 20x6. And the end of the next year, x7, x8, and then x. Okay, so for 20x6, 7, 8, the depreciation expense is going to be equal to the cost, 34,000, minus the original scrap value, 4,000, divided by the useful life 5. So 34 minus 4, 30, divided by 5 is 6,000. Okay, so it's going to be 6,000 every year. So how about 20x9? So 20x9, the carrying amount now is going to be 34,000 minus 666, 18,000. And then minus the revised scrap value, which is 2,000. And we have remaining left 2 years, so divide by 2. So the answer is the depreciation charge. By the way, on your exam, charge means the same as expense. So charge and expense mean the same. So the answer is 7,000. We minus the residual value, and we add any cost of disposal. So 2,000 is the residual value.
So before it was 4,000, then it comes to 9,000. So we should add back to
Yes, you're right. We should add back 2,000. And so before we minus 4, now we minus 2.
before we minus 4, now we should add 0, right?
So actually, you just take.
So it says revise the scrap value to 2,000. Means before the scrap value was 4, now it is 2.
If you calculate the
Why don't we do one more year? So what is the depreciation going to be in the next year, which is year 10? Or I'll put X9 and then Y0. The depreciation next year is going to be? It's straight line, so it's the same, right? Straight line is the same. So next year it's going to be 7,000. So, and useful life is 5 years. It said 5 years up here. So 1, 2, 3, 4, 5. 5 years. So 5 years means we are finished. We're finished using the asset. If we add the depreciation up, it's 18 plus 14 is a total of 30, 32. This is the total depreciation. So the cost had been 34, and the accumulated depreciation, the total depreciation is 32, and so the remaining is 2. So when you're finished using the asset, your remaining value should be equal to your residual value. So residual value is 2, so the remaining value is 2. So the carrying amount is here. Maybe I should put this as a carrying amount. Is the cost minus accumulated depreciation. And then this is the new residual value. So for your exam, you should know what is PPE. You should know the meaning of PPE. PPE are the tangible assets that you're going to be using for more than a year. You should know the cost of PPE. Cost of PPE is all the money that you spend to get the PPE ready to use. You should know that we have the 2 methods to measure PPE. You can use cost or revaluation. If you follow cost, then cost is cost less accumulated depreciation. On your exam, you have 2 depreciation methods. The first is straight line basis. The second is reducing balance. And you should know the formula for straight line. So the formula for straight line is cost minus residual value plus cost of disposal divided by years useful life. And for reducing balance, it is the cost minus accumulated depreciation times the percent. So with reducing balance, we don't minus the residual value. We don't minus or add the cost of disposal. If there's a change in expected life, if there's a change in residual value, if there's a change in the method of depreciation, then the year that you change, you're going to take the new carrying amount divided by the remaining useful life. And that's most of depreciation. Let's take a look at disposal. And disposal means you sell the PPE. And you sell PPE, it's a little bit different than selling inventory. Let's say that you are Barai Penguin and you have a house. Let's say the house cost for you to construct the house cost was 100,000. And the selling price for you is, well, maybe I'll just do it like this. For sale of inventory, so for sale of inventory, we take the selling price, let's say, I'll make it 150,000. Let's say the cost was 100,000. That gives us gross profit. So when you sell inventory, you show sales, you show costs, you show gross profit when you sell inventory. But what do you do if you sell PPE? When you sell PPE, you don't show sales, you don't show cost, you don't show gross profit. When you sell PPE, you only show the profit or the loss. So for sale of PPE, and we don't use the word sale, we say disposal. So disposal of PPE, we don't show sales, we don't show cost, we show a kind of income called gain on disposal. And we would only show, if the profit is 50,000, we only show 50,000. So selling PPE is very different than selling inventory. Selling inventory, we show sales, cost of sales, gross profit. But for PPE, no. If we don't show sales, cost, we just show the profit. If you have a loss, you just show the loss. The profit we use the word gain. If you have a loss, we use the word loss. So we don't say profit. You could say profit on disposal if you wanted to, but normally we say gain on disposal. So we say gain on disposal or loss on disposal. And here's one example of how to do the journal entries for disposal. There's more than one way to do the journal entries. I'm showing you these journal entries because it's simple. It should be easier for us to understand. So here in this disposal, so we have disposal. So first of all, when you sell the building, you sell the machine is gone, right? So the machine is gone, and machine is the asset. So your asset goes down. Should we debit the asset or credit the asset? Credit. So here you can see that we credit non-current asset. So we credit the asset to remove the asset. The asset's gone. And this is the cost. So we debit the cost, credit the asset, we remove the asset. Credit asset makes asset goes down. But what do we debit? Do we debit cost of sales? No, because disposal, we don't show the expense on disposal. We just show the gain or loss. So we don't debit expense. Instead, we're going to debit an account called disposal. And disposal, we're going to, the disposal account will help us define profit or loss. So when we dispose, debit disposal, credit the asset. And next we need to eliminate the accumulated depreciation. So when the asset is gone, the depreciation is also gone. So when you get rid of the machine, you also need to get rid of the accumulated depreciation. Machine is an asset, a debit. Accumulated depreciation is a credit. Accumulated depreciation is a credit because it makes asset go down. It is a contra to asset. So now we need to make accumulated depreciation for the asset go down to 0. So accumulated depreciation is a credit. To make it go down, we need to debit. Now here it says, excuse me, provision for depreciation. This is just, it's another way to say accumulated depreciation. So we debit accumulated depreciation to make it go down to 0, and we credit disposal. And the next part is to record the money we get from selling the asset. Do you always get money when you dispose? No, sometimes you throw away, right? If you throw away and you don't get any money, then you just can do step 1 and 2. But if you dispose and then you get some money, then you need to do step 3. So step 3, we record, it says proceeds. Proceeds means cash received. So debit cash and credit disposal. So this is easy for us to follow. Another way would be to debit accumulated depreciation, debit cash, credit PPE, and if you have a gain on disposal, then credit gain on disposal. Or if you have a loss on disposal, debit accumulated depreciation, debit cash, debit loss on disposal, and then credit PPE. So these are shorter. These are shorter journal entries. But the journal entries shown step 1, 2, 3. This is just broken down for us so that it's easier for us to see what we're doing. So first we remove PPE. Second, we remove accumulated depreciation. Third, we record the cash we receive. So this is 3 steps, but you could do it in 1 step. If you have a gain on disposal, then do it this way. If you have loss on disposal, then do it this way. So you can do gain and disposal in 1 step. You can do the loss and disposal in 1 step. Okay, so here we have a cost of an asset of 25. Accumulated depreciation is 9. So the carrying amount is 16. The selling price is 17,500. So gain on disposal is the selling price. So the selling price, 17,500 minus the carrying amount. Minus the carrying amount equals 1,500. So 1,500 is the profit. So there's a gain. So if we do it in the 3 steps, step 1, step 2, step 3, if we do it in 3 steps, first, debit accumulated. The steps here are actually reversed from the previous slide. Anyway, the first step, debit accumulated depreciation. That makes the depreciation go to 0. Second, we credit PPE cost to make the asset go down. And third, we debit cash to record the cash we receive. Everything goes to the disposal account. The short method. The short method would be to debit accumulated depreciation. $9,000. Debit cash. 17,500. Credit PPE cost. 25,000. And then credit gain on disposal. 1,000. Okay, so you can do it using the short method too. If we look at the profit, if we look at a disposal account here, following the long method, we have a credit to disposal account of 9,000. And we have a debit to disposal account of 25. And then a credit to disposal of 17,500. If the credit side is bigger, then we have a gain on disposal. And then if the debit side is bigger, we have a loss on disposal. So in this case, the credit side is 26,500. The debit side is 25. So credit is bigger than debit. We have a gain. Okay, so we have 2 questions, and after the 2 questions, we'll go to revaluation. So question 1, a company purchased a machine for $50,000 on 1 January 20X1. It was judged to have a 5-year useful life with a residual value of $5,000. On 31 December 20X2, $15,000 was spent on an upgrade to the machine. That's upgrade is like a renovation. This extended the remaining useful life to 5 years with the same residual value. And why don't we say, so remaining useful life of 5 years, so 5 more years. during 20X3, the market for the product declined, and the machine was sold for on 1 January 20X4 for $7,000. What was the loss on disposal? So they're just asking us for the loss. And the years are, we have 20X1, 20X2, 20X3. Only 3 years because they sold it on 1 January 20X4. So we have 3 years. And for loss on disposal, remember, loss on disposal is the selling price. Selling price minus the carrying amount. Equals the loss or gain. And they say the selling price is $7,000. So the selling price is $7,000. We need to find the carrying amount. So that's the missing number. To find the carrying amount, we need to find the depreciation each year. So what is the depreciation in each of the years? Depreciation in year 1 and year 2 is going to be the same. It's straight line. But the depreciation in year 3 is going to be different for 2 reasons. First, you did the upgrade. So you have to add the 15,000 renovation. We need to add. We add to the asset. And then secondly, we've changed the useful life so that we have 5 more years. So the depreciation expense is cost divided, cost less residual value, divided by the useful life of 5 years. So 45,000 divided by 5 is 9,000. In the second year, it's going to be the same. But in the third year, we have accumulated depreciation. 9, 18. And in the next year, the cost was 50,000 minus accumulated depreciation, 18,000, and then we have the renovation of 15,000. So this is the new carrying amount in the beginning of the year 3. And then the new useful life is 5 years.
Should be less residual value.
Yes, thank you. I forgot to minus the residual value. Minus the new residual value, or minus the same residual value, minus 5,000. And that gives us depreciation of 8,400. And the accumulated depreciation now is 8,400 plus 18,000. Accumulated depreciation is 26,400. So the carrying amount to find the gain or loss on disposal, the carrying amount now is 50,000 plus 15,000 minus 26,400. And we have a carrying amount of 38,600. And we have a loss of 31,600. Okay, what would be the debit and credit in this example? In 20x1, when we buy the machine, it says the cost is 50,000. So in 20x1, we debit PPE 50,000, credit cash 50,000. And then at the end of the year, we're going to debit depreciation expense 9,000, credit accumulated depreciation 9,000. In 20x2, we debit depreciation expense 9,000 the same, and we credit accumulated depreciation 9,000 the same. However, the question says at the end of 20x2, what did we do? At the end of 20x2, we did the renovation, the upgrade. So we debit PPE cost 15,000. So the renovation, the upgrade is added to the cost. So we debit PPE 15,000, we credit cash 15,000. And then in the last year, 20x3, we debit depreciation 9,000. Credit accumulated depreciation, the same. 8,400. Credit accumulated depreciation, 8,400. And then we have the disposal. And we have a loss on disposal, so we can debit loss on disposal. $31,600. Debit accumulated depreciation. $26,400. Debit the cash we received. $7,000. And then credit PPE. The $15,000 plus $50,000, which is $65,000. So these are the journal entries. So we can see by the last journal entry, when you have disposal, debit accumulated depreciation, you want to remove, when you dispose, you want to remove all the accumulated depreciation. When you sell the asset, the PPE is gone, so you credit PPE to remove all of that PPE. Debit cash, the cash you receive. If you have a loss on disposal, debit loss on disposal. If you have a gain on disposal, then you would credit gain on disposal. In this case, we have a loss on disposal, so we debit loss on disposal. So when you dispose, the asset is gone. So the PPE cost is gone. Accumulated depreciation is gone. The next question says that the following information relates to the non-current assets of Carson Company in the past financial year. Buildings, machinery, vehicles. We have the carrying amount brought forward. Carrying amount brought forward means carrying amount in the beginning of the year. Additions. Additions means new PPE. New PPE you buy in the year. Depreciation charge. Depreciation charge means depreciation expense. And then we have the carrying amount carried forward. And profit or loss on disposal. I think there must be some mistake in this example because I guess they mean this is a disposal. It's not clear to me what is the what is meant here. Anyway, the question says, what is the total net expense recognized in profit or loss in respect of non-current assets? So non-current assets, we have we have two possible expenses. Number one, the expense is depreciation expense. So the depreciation expense is going to be, for all of these assets, nil, nil means 0, plus for machinery, 178, plus for vehicles is 34. The second kind of expense is gain or loss on disposal. And in this case, we have a gain of 13. We have a loss of 7. So there is a gain on disposal. I'll put your gain on disposal. There's a net gain on disposal of 6. The depreciation expense, 178 plus 34, 212. So what is the net expense? So we have expense of 212. We have income of 6. So the net expense is 206. So that's the answer, although this line is weird. I think that whoever typed this example, they made a mistake somewhere. So net expense means expense minus income. So that's net expense. The next part of our lesson is on revaluation. Revaluation is only for PPE. If you have investment property, you can also revalue, but we don't say revaluation. We say we use the fair value model. It's called fair value model. Whereas PPE, we say revaluation model. So PPE is using the revaluation model. Investment property, if you revalue investment property, it's called the fair value model. For PPE, we might have revaluation gain, revaluation loss. For investment property, we have fair value gain, fair value loss. So revaluation is for PPE. What are we going to revalue in PPE? We would only want to revalue any kind of asset that is going to increase in value. So we wouldn't want to revalue a car, machine, because those assets always go down in value. We may want to revalue land and building. So land and building, especially land, has a possibility of increasing in value. Now, when we revalue at the end of the year. How do we revalue? Can we revalue ourselves? It's possible. But if you are the accountant and you revalue yourself, people might say that you are biased. So when we do the revaluation, we try to have an independent revaluation. Who can give you the independent revaluation for land and building? The real estate company. They can give you the evaluation. So most real estate companies do valuation of land and building. They'll give you a report. The tax department in Cambodia, if we revalue, they want us to use a licensed valuer. The Ministry of Economy and Finance has given, I think, around between 60 to 90 valuation licenses. So there are many companies that have a license to do valuation for land and building. Some of the real estate companies that do the valuation, they charge you a high price. They can charge you $5,000. Other valuation companies, real estate companies, they may charge you $50, $25. So should you get the $25 valuation or should you get the $5,000 valuation? It's up to you. It's your choice. So if you're on a budget, if the cost is concerned, okay, fine. Use a $25 valuation. And how do you get the valuation? It's easy. You just Google real estate valuation. Okay, property valuation service. Property appraisal. Asset appraisal. Okay, so just using Google, IPS, Bonner Realty, Lucky Realty, CBRE. CBRE is the expensive one. Lucky Realty probably is a cheaper one. Okay. Real estate. Okay, so there are many real estate companies in Phnom Penh that can value your real estate. You should value around the end of the year. So you should do the valuation close to your balance sheet date. So most companies in Cambodia, your balance sheet date is December. So you should do revaluation in December. So we revalue at the end of the year. So if we revalue, do we need depreciation? The answer is yes, for PPE. For PPE, when we revalue, we still calculate depreciation. So we have to minus depreciation first, and then we calculate the gain on revaluation. If you revalue investment property, though, there's no depreciation. But if you revalue PPE, yes, we have depreciation. The gain on revaluation for PPE does not go to profit. It does not make your profit go up. It goes to a new kind of income that's outside of profit called OCI, Other Comprehensive Income. So accounting for revaluation, it's kind of like disposal in a way, because we make accumulated depreciation go to zero. So you debit non-current asset to make the non-current asset go up, your land. So debit land, make land go up or building go up. And then you debit accumulated depreciation. So if you revalue a building, your accumulated depreciation goes down to zero. And then you credit revaluation surplus. Revaluation surplus is in your income statement. It is OCI, which stands for Other Comprehensive Income. Most companies in Cambodia don't revalue, but we have to know it for our exam, so our exam might have revaluation. So let's look at an example. So land, we have two examples here, land A and land B. Land A, the value goes from 4 to 5, we go up. Land B goes 80 to 65, going down. So this is pretty easy. Land A, go up, debit land 100, credit revaluation gain and OCI 100. If your land goes down, debit expense, credit land. Now this expense though is in profit. So OCI is outside profit. So your gain is outside profit, your loss is inside profit. There are some exceptions where losses can sometimes be in OCI and gains also can sometimes be in profit. How do you know if the gain or loss should be in profit or OCI? Any gain or loss above the original value, any gain or loss above the original value is in OCI. Any gain or loss below the original value is in profit. So for land A, the original value, the original cost, original value is 400. So when you go to 500, you are above the original cost. So that's in OCI. So any gain or loss above the original price is in OCI. Any gain or loss below the original price is in profit. So in this case, the original cost is 80. So you go down to 65, you are below the original cost. But, okay, we'll get to this. So here's practice. This is pretty easy. So case 1, land X, we go, the original cost 1,400, we go up to 1,750. So what should we do? We're going to debit land how much? 350, and then credit revaluation gain in OCI 350. Okay, we went above the original price. For land Y, we go down. So we credit land because land goes down. That's pretty clear. But what do we debit? We're going to debit expense and profit. Where does profit go on the balance sheet? So we have income, expense, profit. And then profit goes to, does profit go to asset, equity, or liability? Profit goes to equity. What is the name of the account in equity where we keep profit? Retained earnings. Profit goes to retained earnings. OCI does not go to retained earnings. OCI goes to a separate equity account called a revaluation reserve or reserve. So profit goes to retained earnings, OCI goes to reserve. So this OCI 350 here, this goes to the revaluation reserve. The expense 120, this will go to profit and then go to retained earnings. Before we continue, let's remind ourselves about OCI. Most companies in Cambodia don't have OCI. So maybe you never saw OCI. So you feel like, what is OCI? It's confusing. Let's see. Do we have OCI in the very first lesson that we had? Let's check. Let's see. Maybe the file is over. Okay, in the very first lesson that we had, I gave you an example here that says James Cropper, we have revenue, some expenses, and operating profit, interest expense, profit, tax expense, profit. So we have profit. And the profit for this company was 4 million pounds. And how about OCI? OCI they have on the next page. And this is called a statement of comprehensive income. And the starting number is profit. So it starts with profit. And then we add and minus some OCI. Now their OCI is foreign currency translation, cash flow hedge, retirement benefit adjustment, and deferred tax on the benefit adjustment. Now for our exam, we don't have any of these OCI. For our exam, we just have one OCI. The one OCI for our exam is revaluation gain. So we would have one revaluation gain line here in OCI. And then profit plus OCI is equal to total comprehensive income there on the bottom. So the OCI section for this company, they put on a second page. So the first page, they have statement of profit or loss, and then after profit, OCI, and then OCI plus profit is total comprehensive income. In Cambodia, most companies don't have any OCI, so for Cambodian companies, it's okay just to show the profit or loss, that's fine. But for our exam, we have the revaluation gain on property. We have OCI. So for our exam, we need to add the OCI section to show the gain on revaluation. How about a revaluation gain and then a loss? It means we go up and then we go down. So last year we went up, and then the next year we went down. So what should we record in at the end of the second year here? So in the beginning of the year, in the beginning of 2020, the carrying amount of the land was 500. So this one. At the end of 2020, the value of the land went down to 370. So we went down. We went down 130. So we have a revaluation loss. How much of the loss should go to profit? How much of the loss should go to OCI? We have to think about the original price. What is the original price? 400. So 400 is the original price, the original cost. So when we go down 500 to 400, this 100 is going to be in OCI. And then we go below the original cost. We have another loss of 30. This is going to be expense in profit. So any changes above the original price is in OCI. Any change below the original price is in profit. So the total loss to the land, we credit land 130, we debit expense 30, and we debit revaluation loss 100. So expenses in profit. In the next example, we're going up. So in the beginning, of, maybe I'll just do it the same way as I did it in my school. Okay, so the beginning of 2020, the carrying amount of the land is 65, and by the end of the year it goes up to 97. So the gain is 32. How much of the gain is in profit? How much of the gain is in OCI? We have to see where the original cost. What is the original cost? 80. So the original cost here, 80. So from 65 to 80 is below the original cost. This is going to be in profit. And then above the original price is going to be in OCI. Now this is a gain, so it's not expense, it's going to be income. So we have income of 15 in profit, and we have a gain of 17 in OCI. So any change, the original price is 80. So any change under the original price is in profit. Any change above the original price is in OCI. So land X for 2020 here, we go down. So we go from 1750 to 1350. Should we debit land or credit land? Land down. Land is an asset. Land down. Credit land. $400. And how much should we debit? How much should we debit to expense? And how much should we debit to OCI? And for land Y we go up, so debit land. For land Y, how much should we credit to OCI? And how much should we credit as income and profit? So debit land goes up 210. So how much to credit to OCI and income and profit? So this will be the last thing we do today. I'd like to give you 2 minutes just for you to decide yourself. So for land X, how much do we debit expense? How much do we debit OCI? For land Y, how much do we credit to OCI? How much do we credit to? Okay. So for land X, how much to debit to expense? 50. So expense is how much we go below the original price. The original price was 1,400, so 1,400 minus 1,350 is, and the rest goes to OCI. And for land Y, how much goes to OCI? 90. Because the original price is 600, so above 600 is only 90. And then the rest will go to income. Since it's a gain, it's not expense. It'll be income. So when the price goes down, that's expense. When the price goes up, or the value goes up, that's income. So this is land. We've practiced accounting for revaluation of land. We have one more revaluation to learn, which is revaluation of a building. Revaluation of building is similar. It's similar to land, but we just have one more step.